Welcome to Breaking News to Trading Moves.
Glad to be here.
Today, we're focusing on a major corporate transaction, Parker Hannifin's move to acquire Filtration Group. That's a pretty hefty price tag involved.
It is $9.25 billion. And when a major player like Parker makes a move like this, it gets attention. Our goal today is really to look at how this single event might adjust things, the competitive landscape, maybe valuations, across a few industrial sectors.
Right. We're aiming to trace the potential impacts, moving from the headline deal to who might come out ahead and who might face some new challenges.
Exactly. Based purely on the material we've reviewed. No personal calls here, just analyzing the expected outcomes.
Okay, so let's lay out the core news first. Parker Hannifin, that's ticker PH, is buying Filtration Group, $9.25 billion. What's the main strategic thinking behind this? Why Filtration Group specifically?
Well, it really boils down to one key thing: resilience through aftermarket sales. Parker is aiming to build, one of the biggest industrial filtration platforms out there. But the real prize, the reason for that valuation, seems to be Filtration Group's business model. But 85%, maybe even a bit more, of their sales come from recurring aftermarket services.
85%. That's a huge chunk focused on stability, not just one-off sales.
It is. Think about industrial settings, cars, HVAC systems. Filters need replacing constantly.
Yeah, it's not really optional.
Exactly. So that 85% isn't just revenue. It's steady, predictable cash flow. It's tied to maintenance, repair, overhaul, MRO, and just regular replacement cycles. Filters wear out. That happens whether the economy is booming or slowing down.
So it provides a buffer against those economic cycles that can hit purely capital expenditure-driven businesses harder.
That seems to be the thinking. That consistency, that predictability, that's what the market often pays a premium for. It helps justify that $9+ billion number.
Makes sense. So it's about building a more durable revenue base. What about the mechanics of the deal? Timing, how they're paying for it?
Parker expects it to close within, say, 6 to 12 months. Standard time frame for something this size. They're using cash they have on hand, plus taking on some new debt.
Okay.
And importantly, management is forecasting about $220 million in pre-tax synergies by the third year post-close.
Which suggests they're pretty confident they can integrate Filtration Group smoothly and find those cost savings or revenue boosts.
Yeah, that's the signal they're sending. Confidence in making it work efficiently.
All right, let's broaden the view a bit. This transaction isn't happening in a vacuum. It's seen by many as, well, a validation of the whole industrial filtration and flow control space.
Well,
When you see consolidation like this, what generally happens next for the sector?
a few things tend to happen. The combined company obviously gets much bigger scale. That means a larger installed base of equipment out there that needs servicing and parts.
Right, more machines needing their filters.
Exactly. And that scale can also lead to better cross-selling opportunities, selling Filtration Group products to Parker customers and vice versa. But maybe the most important aspect is the potential for better pricing discipline.
Pricing discipline, how does just being bigger translate into being able to charge more or hold prices firm in a specialized field like filtration?
It's about leverage, really. When you command such a large part of the market, especially across diverse areas like industrial, auto, and HVAC, you have more influence on specifications, on large contracts.
Ah, okay.
Smaller competitors might struggle to match the offering on, say, big infrastructure projects or global supply deals where consistent quality and, just as importantly, reliable supply across the globe are key. It's harder to compete when the big player can offer a more complete, secure package.
Got it. Scale becomes a competitive barrier in itself. Okay, let's walk through the segments expected to benefit from this. We've got three main groups identified as potential winners. First up, the direct peers in filtration and flow control.
Yeah, this is the industrial filtration and flow control consolidation theme. The thinking here is pretty straightforward. Parker paying that premium price sort of re-rates the whole sector. It suggests the market sees strong long-term value here.
So potentially lifts the valuation multiples for similar companies?
Potentially, yes. And it reinforces the idea that having strong service networks and disciplined pricing pays off. So beyond Parker Hannifin itself, ticker PH, you'd look at its peers.
Like who?
Companies like ITT, that's ITT, and Flowserve, ticker FLOW. They operate in the same space, and the deal might indirectly highlight the value drivers for their businesses too.
Okay, second group of winners. Companies involved in HVAC, water, and indoor air quality. Why does an industrial filtration deal help them? Seems removed for you.
It's because Filtration Group already had a decent footprint in these areas, and Parker's scale can amplify that significantly. Think about clean air and clean water standards. They're constantly evolving, often getting stricter.
True. There's a lot of focus on that.
Right. So the combined Parker Filtration entity, with its bigger R&D budget and wider distribution reach, could push for a higher spec, higher margin filtration solutions to meet those standards. They can try to capture more wallet share from customers upgrading their systems.
So they can leverage the push for cleaner environments to sell more advanced and likely more profitable filters.
That seems to be the angle. This could benefit companies linked to those clean standards, companies that supply related equipment or systems where high-quality filtration is essential.
And who falls into that category?
You'd think about companies like Xylem, ticker XYL, SPX Technologies, SPXC, and AO Smith, AOS. They're all connected to infrastructure and building systems where clean air and water are critical, driving that need for ongoing filtration.
Okay, that makes sense. Now, the third group of beneficiaries is maybe less obvious. It's on the supply chain side. MRO and industrial distribution, the companies that actually move the parts.
Yeah, their benefit is more about logistics and volume. Simple equation, really. A bigger installed base of Parker and Filtration Group equipment means more replacement filters and related parts needing to be distributed.
So steady demand flowing through their warehouses.
Exactly. It translates into more reliable, predictable throughput for these broadline distributors. That aftermarket focus we talked about, that 85% number, that's music to the ears of distributors because it means consistent volumes, less cyclicality than selling big new equipment.
It might not be glamorous, but that MRO business is steady. Who are the key distributors likely to see this consistent volume?
The big names here are W.W. Grainger, ticker GWW, and Fastenal, FAST. The deal reinforces that reliable flow of aftermarket parts, which is core to their business model.
Okay, so those are the potential winners. Direct peers, clean tech suppliers, and the distributors. Now, we need to look at the other side. When a giant gets bigger, someone else usually feels the pressure who might be facing some headwinds from this.
Right, consolidation inevitably creates pressure elsewhere. The first group likely feeling it are the smaller, niche filtration companies, particularly those that compete mainly on price.
You might think a bigger competitor drives customers to the cheaper option, but it doesn't always work that way.
Not necessarily, especially on larger, more complex deals. The combined scale of Parker and Filtration Group makes them a tougher competitor on big contracts, like multi-year framework agreements or large OEM supply deals.
Why is that?
They can offer things smaller players might struggle with: global supply security, a wider service network, maybe even volume discounts on a bundled offering. Smaller companies might find it hard to match that without really hurting their own profit margins.
So they could get squeezed on pricing or even lose out on bids altogether against the bigger entity?
That's the risk. We could see pressure on companies like Seco Environmental, ticker CECO, and Ecovist, ECVT. Their challenge is competing against that enhanced scale and reach.
Okay, second category, facing potential pressure. Diversified industrials that have some overlap in fluid handling or filtration, but maybe it's not their sole focus.
Exactly. These are large companies, but perhaps filtration isn't as central to them as it now is to Parker. The new combined Parker Filtration entity is now a highly focused, integrated competitor in this specific space.
So even if they're big overall, they might face a tougher fight in this particular market segment.
Yes. The new Parker entity might be able to compete more aggressively on price or service for certain projects, potentially pressuring margins for these diversified players in those overlapping areas. They might also be better positioned to grab more of that lucrative aftermarket business,
limiting the growth for others who don't have quite the same specialized focus or service density.
That's the potential dynamic. Companies that might feel this include Dover, ticker DOV, and IDEX, IEX. They compete in related areas, but now face a more formidable specialized rival.
All right, one last group potentially feeling some negative impact, and this one's a bit indirect. HVAC OEMs, the makers of the actual heating and cooling units. Why them?
This is really about input costs. It comes down to the cost of goods sold, or CAGS filters are components that go into HVAC systems.
Right.
So if this consolidation leads to firmer pricing for filtration components, maybe not immediately, but over time, then the HVAC OEMs could see a mild increase in their costs.
Before they can pass that cost increase along to their customers in the form of higher prices for the finished air conditioners or furnaces.
Exactly. There can be a lag, especially around contract renewals. It might cause a bit of temporary pressure on their margins until they can adjust their own pricing. It's probably not a major long-term issue, but it could cause some near-term instability.
Okay, a potential short-term margin squeeze for them. Which companies fit this profile?
You'd look at the major HVAC players like Carrier Global, ticker CARR, and Trane Technologies, TT.
Got it. So we've covered quite a bit there, from the core deal rationale to the potential winners like peers and distributors, and then the possible pressures on smaller players, diversified competitors, and even OEMs.
It does illustrate how one large move in a sector can send out effects in various directions, touching different parts of the industrial ecosystem.
Definitely. But if you had to boil it down, what's the final thought here? What's the main strategic theme underscored by this $9 billion bet?
I think it comes back to where we started. The strategic value of recurring revenue. That huge price tag, $9.25 billion, seems largely driven by the stability and predictability of Filtration Group's 85% aftermarket sales.
The market paying up for consistency.
Precisely. It reinforces that in the industrial world right now, having those durable, predictable cash flows from service and replacement parts, it's highly valued, perhaps more so than just chasing big one-time equipment sales.
A really valuable point. It makes you wonder who else out there has that kind of attractive, high-percentage aftermarket business now that Parker has set this benchmark. Something for listeners to think about.
Indeed. And, of course, we have to state clearly, this discussion was based on the analysis provided to us. It is not financial advice. We aren't recommending you buy or sell any securities mentioned. This is purely reflecting the perspective of the author of the material we reviewed.
Absolutely. Important reminder. Thanks for tuning in to Breaking News, to Trading Moves.